CVI Cryptocurrency. How to use the Crypto Volatility Index. In the past few years, news has been abuzz of cryptocurrencies. Superior returns and new developments have been making headlines. The crypto space has grown massively, and in the same breath comes the Crypto Volatility Index. What is it? How can you use it? What are its pros and cons? Eye-opening watch if you're a crypto enthusiast. I suggest you sit back and grab a cup of coffee. Still, in crypto matters, do you think investing in crypto is a risk worth taking? Let us know in the comments section below. Without further ado, let's get right into it. The Crypto Volatility Index, or CVI, is a decentralized solution used as a benchmark to track the volatility from cryptocurrency option prices and the overall crypto market. To understand CVI well, let's get to learn what volatility really means in the business world. Volatility is a measure of how much the price of an asset has moved up or down over time. Generally, the more volatile an asset is, the riskier it's considered to be as an investment, and the more potential it has to offer, either higher returns or higher losses over shorter periods of time than comparatively less volatile assets. As a newer asset class, crypto is widely considered volatile, with the potential for significant upward and downward movements over shorter time periods. Stocks are considered to have a wide range of volatility, from the relative stability of large-cap stocks like Apple or Berkshire Hathaway to often erratic penny stocks. Bonds, by contrast, are considered to be a lower volatility asset and typically see less dramatic upward and downward swings that take place over longer time frames. A relatively new platform, CVI was developed and launched on the Ethereum MainNet on January 20, 2021 by the GOVI team in collaboration with Professor Dan Galai, creator of the VIX and part of the CVI Board of Advisors. In simpler terms, the Crypto Volatility Index is a decentralized VIX for crypto that allows users to hedge themselves against market volatility and impermanent loss. For those who are not familiar with the term, the VIX is an index that measures volatility in the stock market based on the implied volatility of S&P 500 index options. It's also referred to as the Market Fear Index. Similarly, the CVI helps users track and trade the 30-day implied volatility of Ether and Bitcoin by using the Black-Scholes options pricing model to foster an index that fluctuates between 0 and 200. Black-Scholes is a pricing model used to determine the fair price or theoretical value for a call or a put option based on 6 variables: volatility, type of option, underlying stock price, time, strike price, and the risk-free rate. The CVI is created by computing a decentralized volatility index from cryptocurrency option prices, together with analyzing the market's expectation of future volatility. Traders can use the index as a tool to either speculate or hedge on their portfolios if they think the volatility in crypto is going to increase. As we've mentioned, the index can fluctuate between two numbers, 0 and 200. 200 will indicate the maximum level of volatility in the market, while 0 indicates low volatility. Whenever you see the prices of Bitcoin and Ether drop substantially, the index will spike in the opposite direction. Traders can open a position on the CVI platform by simply connecting to their MetaMask browser extension and either selecting the buy or sell option, depending on which side of the volatility they want to trade. Besides trading the index, users can also participate by providing liquidity to the platform. An interesting feature is that liquidity providers on CVI play the role of the counterpart for every trade made on the platform. In other words, if a trader buys insurance against volatility or stagnation, the liquidity providers play the role of the insurance company. This is a great position to be in, as it's much more lucrative than simply providing liquidity for a small fee and being at risk of impermanent loss. The GOVI token governs the CVI project, and holders of the token can vote on matters such as leverage use, platform fees, deposit use, and tradable assets. GOVI allows its holders to collect platform fees by staking the token. In order to avoid high gas fees from using the platform on the Ethereum blockchain, the team has managed to release a contract optimization model to cut down gas costs by about 40%. In addition, users can also benefit from a more cost-friendly and almost instant experience by using the platform on the Polygon sidechain. CVI uses a Chainlink-powered decentralized Oracle network to aggregate market data options from multiple off-chain sources and deliver them on-chain. In order to ensure decentralization and transparency, Chainlink architecture uses multiple independent oracles that use external adapters to retrieve trading options data from across the market to calculate the CVI. CVI uses Deribit Exchange as its main data source for index calculations, as it's the most advanced and widely adopted platform for derivatives and options. Volatility is one of the primary factors that go into assessing investment risk. Traditionally, investors will take on a high level of risk if they believe the potential reward is worth the possibility of losing some of their investment or all of their investment, as in the recent case of high-risk hedge fund manager Bill Hwang, whose entire $20 billion fund disappeared in 2 days. For investors, it's important to learn how to use CVI as an advantage. The cryptocurrency industry is currently valued at more than $1.9 trillion. Bitcoin alone has a market cap of more than $1 trillion, yet it's still one of the most volatile assets to invest in. However, the recent rally has seen many investors overlook Bitcoin's traditional volatility concerns as they continue to buy it. But based on the historical performance of the cryptocurrency market, many would argue that buying and holding for the long term may not be the best strategy. The good thing is, there are alternative investment strategies that traders can use to profit from the inevitable volatility of the cryptocurrency market. They include buying and holding short-term, trading the volatility, and buying and holding indefinitely. Buying and holding is what everyone buying Bitcoin is essentially doing. The level of volatility means that you could buy Bitcoin with a view of selling when it hits a certain price level, only to sell sooner. So you can't really put a time frame on when you plan to sell unless you're a day trader that has no interest in owning crypto. But then again, if you consider those who invested years ago, you can see the benefits of holding indefinitely. They've managed to ride out all those pullbacks. The current rally looks set to continue further as experts predict Bitcoin to trade in the region of $100,000 at some point in the near future. Whether that takes 8 months, a year, or 2 years remains to be seen. It's the indefinite wait, a wait that's likely to bear sweet, sweet fruits. Traditionally, retail investors are advised to diversify their investments within an asset class as a way of reducing risk. One popular strategy is to invest in a basket of stocks or an index fund rather than just a few. To further reduce the downside potential, they may also pair investments with more volatile asset classes like stocks with less volatile ones like bonds. As an asset class that's only a little more than a decade old, crypto has seen a series of steep rises and subsequent fails, and is considered to be more volatile as a category than stocks. That said, higher trading volumes on Bitcoin, which is by far the biggest cryptocurrency by market cap, and increased institutional participation seems to be reducing its volatility over time. Cryptocurrencies with lower trading volumes or emerging crypto assets like DeFi tokens tend to have higher volatility. When experimenting with these assets as a beginner, it's best to risk amounts you can afford to lose. Factors that can increase volatility include positive or negative news coverage and earning reports that are better or worse than expected. Unusually high spikes in the volume of trading will usually correspond to volatility. Very low volume, as seen with so-called penny stocks that don't trade on major markets or smaller cryptocurrencies, also usually corresponds with high volatility. Aside from CVI enabling users to transform infamous crypto volatility into assets, they recently launched volatility tokens, ETHVOL and CVOL. The first of their kind funding fee-adjusted rebased volatility tokens mark the emergence of a novel solution for trading crypto volatility. So in summary, the primary reason for volatility in cryptos is their newness. All new concepts take time to settle and be accepted, and the same holds true for cryptocurrencies. The asset class, the market, as well as investors and speculators are still finding their feet, and so it's still the initial stages of price discovery. Cryptos have gained global prominence in the last few years, but as an asset class, they're not as accepted as traditional assets, such as equity or gold. Growing acceptance and maturity of the market go hand in hand. That's why when Tesla indicated that cryptocurrencies would not be accepted as a mode of payment, the value of Bitcoin crashed. But when Tesla boss Elon Musk wrote Doge on his Twitter post, the value of Dogecoin went up. Such influencing events or personalities are adding to the volatility, just the way when some star investor buys a particular company's shares, the prices of that share tend to rise. Given the lack of understanding and rules, trading is at present highly speculative. Investors bet on the prices going up or down, and these speculative bets cause a sudden influx or outgo, leading to high volatility. But for traders who will master how to employ CVI, they might as well reap big. After all, the risk of volatility can be rewarded with high returns if carefully handled. In that sense, volatility is not an enemy. That's it for us today. In your opinion, what do you think is the best way or tool to handle or manage crypto volatility? Let us know in the comments section below.